Welcome back everyone, my name is Ali Casey and you are watching Stat Oasis channel. Today we are diving into the thrilling world of breakout strategies. I will show you how easy it is to build breakout strategies on different instruments. And then we will use that knowledge to build 10 different strategies on multiple instruments. Then we will combine all these strategies into a winning portfolio. So grab your notepads, hit the like button and let's start. Breakout strategies are the bread and butter for many hedge funds and they are an integral part of every professional trader as they offer unique opportunities to capitalize on market momentum. I know all this sounds gibberish, so let me show you some examples on how to spot breakout opportunity. This is a chart of the Euro US dollar on daily time frame. And I plotted here some breakout opportunities. So you can see here, this is a channel and this is a breakout. This is the triangle and this is a breakout. And if I go back, so this is a support that was broken on the way down. So this is a breakout to the downside. And then this is a head and shoulder, inverted head and shoulder. And this is the neckline. And again, we have a breakout on the downside and so on and so forth. Of course, all this is garbage and I don't do this, but I just, wanted to have fun. We are algorithmic traders. We follow rules. Basically, all the systems are pre-built with a defined set of rules to enter and exit. So this mumbo jumbo doesn't work. So let's do the real thing. So today I will use an extremely simple breakout strategy. Basically, we will enter long when the close is higher than the close X number of bars ago. And we will exit when the close is lower than the close X bars ago. And it's opposite for shorts. That is it. This is the strategy. Now, don't worry about the code. I usually post the code or the indicator or all of them under the video in the Stat Oasis community in the YouTube channel. I know you're disappointed. You expected something very complicated, but all strategies that are profitable usually very simple, especially on long time frame like daily time frame. Now, that doesn't mean you cannot build a complicated strategy and make it profitable, but in this video, we are making things very simple. The reason is so you don't depend on any trading platform or backtesting platform, so you can apply this even in Excel. So this is the entry and the exit, opposite for shorts, and I will add 6 filters. So these filters, this is an oscillator, filter 1 and 2, filter 3 and 4 are volatility, and filter 5 and 6 are direction. Now, of course, you can add 100 more filters, and actually that's what I'm doing in version 2 of the Algo Trading Masterclass. But usually this is the simplest way to start, and usually you will get results with volatility, direction, and oscillator. So I will start with the gasoline futures. The symbol is RB. This is the daily time frame since 2007. And as usual, I will build the long and short separately. Now, breakout strategy and trend following, for me, it's the same thing. Now, I know some people try to put it in a different category, but to me, it's the same thing because trend following depends highly on some form of a breakout pattern. So to me, and this is the general definition in the hedge fund space, a breakout strategy is usually a short-term thing. So 1 to 7 days, that's a breakout strategy. And then 7 to 40 days, that's usually a short-term trend. So if you are looking at any indicator, 7 to 40, that's usually following a short-term trend. 40 to 80 look-back period usually captures a medium trend. And 80 to 160 usually considered a long-term trend. Now, there are some hedge funds that trade above 160. I've seen hedge funds with 200-day breakouts. Of course, you can add your own interpretation on top of this, but if you have a workflow, it's actually very beneficial to fix those things because then it's easier for you to say, okay, I'm going to combine short-term with medium-term. And you know what short-term is and medium-term is. And these are our optimization settings. So BLS is both long or short. So one that is long, And then we have the entry look back and the exit look back. So this is the close higher than the close 40 bars ago. And this is the close lower than the close 4 bars ago. So we'll go from 40 to 80 to enter, step 5. And we will exit when the close is lower than the close 4 bars ago. And we will take that to 24 in step of 2. And then we have 6 filters. So 0, there is no filter. And then 1 through 6. So all in all, we have about 700 combinations. So this is long only. This is the result of the optimization. So let's look at the 3D graph of all these points. And let's maximize that. And let me set the water level, that's the blue plane, on $100,000. So now everything above the water level is more than $100,000. And we can see that without a filter, we have this region is a stable region. So this is 70 or 60. So this is 65 and 70. So 65 and 70 looks good with 8. Okay, so I'm looking at this point here. But let's see if we can enhance that with a filter. So this is filter 1. It's stable, but we make less money. Let's see, filter 2. So filter 2 is not good. I mean, there is no stable area unless you're down there. And filter 3 is very stable, but again, we're making less money. Filter 4 also looks good. So filter 4, maybe this point here, which is 65 and 8. So again, we are in the same point. And then filter 5, again, 65 and 8 looks very good. And finally, filter 6, it looks like here is the stable. So I'm looking for filter 4. To me, that's the best one. So 65 and 8 or 65 and 6. Now, once I find the stable region, I need to look at the maximum intraday drawdown, and let's put the filter on, and let's see 65 and 8 or 6. So 65 and 8 sits here, and 65 and 6, it's this red point. So it's worse. I mean, the drawdown is worse with 65 and 6. So I will pick that point, because then at least I am picking the worst point, and hopefully the future will be either the same or better. So if we go back to our spreadsheet, so let's sort by this, and we're looking for 65 and 6. This is 65 and 6 with filter 4. And as you can see, we are making 2.5 times return to drawdown ratio. Our average trade is 548, which is very good for gasoline. So if I pick this strategy, and remember, this is long only. So trade analysis, 276 trades, $548 on average, and we're making $151,000, 3-to-1 return to drawdown ratio, and 64% win rate. But if we look at the equity curve doesn't look that good. I mean, the strategy performance is good, all the metrics are good, but the equity curves looks bad. This is usually where we are different from everybody else when we are building a portfolio. Because when you are building a portfolio, you're not concerned that much with the look of the equity curve. I mean, obviously, I want to have a smooth equity curve sloping up with all the metrics being good. But when you are building a portfolio, that really doesn't matter a lot, because more strategies will be combined with this one. And as long as they have low correlation with the strategy, your equity curve will be smooth on its own. So we gain the advantage by looking at the strategy metrics without trying to smooth our equity curve, and therefore probably we are overfitting the strategy. Okay, now let's look at the short side. So let's go back here, and it's the same everything, but now I'm only gonna switch this to 2. So 2 is short. We will do the same optimization, same number of iterations. So again, let's pull up the 3D graph and let's maximize that. Okay, so let me set the water level at 30 as we don't have many profitable strategies. No strategy with a filter except this one making more than 30,000. Let's look at this is filter 1 again. Filter number 2, nothing. And filter number 3 looks stable. So let me put this down a little bit so we can see it clearly. And you can see this is a very stable area over here. So anything between 70, so anything between 55 and 70 is good on the entry, and number 8 on the exit is good. So this is a stable area between 55 and 70 and 8, 6 to 10. So 6 to 10, they're all good. And now let's look at the intraday drawdown, and let's put the filter. And this is wonderful. So you can see that all this area having really a very stable drawdown region. So 6510 filter number 3. Our average trade is 389. Total trades 100, and we're making $40,000. So let's pick that up and let's see how it looks like. So this is now the short side. And again, the equity curve doesn't look that great. I mean, it's good strategy. We know it's good. And we are profitable. The slope is up. But I mean, it doesn't look like, you know, the normal YouTube strategies where it's a smooth curve up. Again, I want to bring your attention that today in this video, we are building a portfolio. So the equity curve doesn't matter that much as long as it is up. But if it's not, you know, a very beautiful sloping 45 degrees up, that doesn't matter. It's okay. As long as we're going to add more uncorrelated strategies in a portfolio, this will help a lot. So the strategy robust, having good metrics, the equity curve is up, sloping up. If it's ugly, that's fine, because you are not trading this strategy alone. And here where all the magic is going to happen. So now I build a portfolio. Now I did the exact same analysis. Of course, I'm not going to repeat it, and then this video will be 2 hours long. So this is the copper long, and this is the copper short. So, and gasoline long, gasoline short, and then heating oil long, and then Euro USD short, and then Euro dollar. So this is an interest rate. It's not the same as Euro USD, and this is long. And then Japanese USD dollar short, and finally the US dollar long. So these are 10 strategies, some of them long, some of them short. Some instruments like the copper and the gasoline have long and short in this portfolio. They are all using the data since 2007, and we're trading 1 contract per instrument. No slippage, no commission. No slippage, no commission is not there because, you know, I'm trying to hide something. I do actually look at slippage and commission, but I do it in a different way. So here is the way I do it. Let's say you build a strategy on the S&P 500, and the strategy makes $40. So the strategy has an edge, but the edge is not enough. So you definitely need a filter to boost that edge. Now, maybe you can, maybe you can't, but you don't know. But if you add $50 slippage and commission from the beginning, then that strategy will be losing from the beginning. So you will not have a chance to add the filters. Now, of course, this is subjective. It's up to you, and it's up to your workflow. So my workflow, I need to look at the raw edge in the beginning, then add the slippage and commission later. In fact, I don't even add it until at the end, because I know when I'm, let's say, building on the S&P, I need at least $100 on the average trade. So what you want is, if you don't include slippage and commission, your average trade needs to be at least 3 times slippage and commission. So that is the ratio I use. Of course, the higher the better. 4 usually is where I sit. But, 3, and I'm really liking that strategy, or it really sits well in a portfolio, then I don't mind. So, of course, all these strategies that I just show you in the portfolio, although slippage and commission is not included, but each strategy has at least 3 times slippage and commission in the average trade. Okay, so going back to the portfolio, and let's backtest this portfolio and let's see what we get. So this is a breakdown of the portfolio. So this is copper long, copper short, gasoline long, gasoline short, heating oil long, euro, US dollar short, and then euro dollar long, and then Japanese yen, US dollar short, and then the US, which is the 30-year treasury, we are having a long strategy. This is the net profit produced by each strategy. That the strategies that are making the most money also have the biggest drawdown. So all in all, I would say this portfolio has equal weights even without position sizing. The performance is $861,000 since 2007. Percent profitable is about 54%. Our maximum portfolio drawdown is $62,000. So now our return to drawdown is 13.75, which is impossible to get in any of the single strategies separately. And then if we look at the equity curve, now we have our smooth equity curve. And look how beautiful is this. I mean, of course, we have drawdown here, we have drawdown here, drawdown here. But all in all, we are smoothly churning up all the time. This shows you where we are making new highs with the green dots. So you can see here we have drawdown, here we have drawdown, and this is the longest drawdown. So you can see here it's $41,000, $42,000, but it is about 7% at this point in the portfolio. Looking at the trade analysis, we have about 3,000 trades with an average of all the trades of $292. Now, as I told you, each strategy average trade covers more than 3 times slippage and commission. But this is averaging all the strategies together for short and long. Periodical analysis since 2007, we are profitable, of course, every year except 2018, where we lost $50,000. This is the most important part of the portfolio. This is the daily equity correlation analysis. So that means we are looking at the daily returns of each strategy, and we are seeing how correlated it is with the other. Of course, I built it, I select the strategies on purpose to show this, because this is what you're aiming for. It's not necessarily you're going to get this in the beginning, but the more strategies you have, the easier it's going to get to this. But this is your ambition, is to get 0 correlated strategies. Now, I know it doesn't look like 0, but believe me, this is 0. 0.12, 0.01, 0.09, all these are considered 0. The only high correlation we have is here. So this is heating oil long, and this is gasoline long, and they are 0.16. Now, this is considered very, very low correlation. But in our portfolio here, this is the highest correlation. Now, here I want to point out a very important takeaway, which is the diversification doesn't come usually from the instrument in the beginning. The style of the strategy and the direction of the strategy have a huge impact on the diversification in a portfolio. So yes, you can have diversification from other markets, but even on the same market, just by separating long and short and building separately on those directions on the same instrument, you will get much better diversification than building long and short in the same strategy. Now, of course, trend following is a perfect match for mean reversion strategies. So even though this whole portfolio was built on trend following strategies, breakout strategies, it is actually a very good idea to mix it with mean reversion strategies, because mean reversion strategies, by definition, they are not correlated. Also, they have higher win rates, so they will bring the win rate up. Also, you can add to the mix volatility breakout strategies, because they are usually also not correlated to this type of strategy. And to learn how to build volatility breakout strategies, watch this video and I will see you there.